We are living through a moment of technological rapture. Every headline, every earnings call, every government strategy document tells us the same story. Artificial intelligence is the new electricity. It is the invention that will rewrite the laws of productivity, cure diseases, and generate trillions of dollars in new wealth. The stock market has responded with euphoria. The Magnificent Seven tech giants have added trillions to their valuations, pulling the entire global economy upward on their shoulders. We are told this is a new industrial revolution. But beneath the surface of this glittering narrative, there is a dark and terrifying mathematical reality. While the world looks at the stock prices, the financial historian looks at the balance sheets. And the balance sheets are telling a story of unprecedented danger. We are witnessing a phenomenon that experts are calling the AI Credit Inflection Point. To fund this revolution, big tech is not just spending profits. They are borrowing. They are issuing debt on a scale that rivals sovereign nations. They are building a financial structure that depends on perfection in a world that is anything but perfect. The core of the problem is not the technology. It is the timeline. These companies are borrowing money for 30, 40, or 50 years to buy computer chips that will be obsolete in 3. They are financing a perishable asset with long-term liabilities. This is the exact same duration mismatch that causes banking crises. It is the same structural flaw that broke the savings and loans in the 1980s. And now it has infected the largest companies on Earth. Welcome to the Financial Coin Historian. Today, we are not looking at the hype. We are conducting a forensic audit of the AI bubble. We will explore the circular financing deals that fake revenue. We will analyze the $405 billion capital expenditure bet that has to pay off, or else. And we will answer the question, what happens when the AI debt bomb finally explodes? To understand the scale of the risk, we must first understand the scale of the spending. The numbers we are seeing today are not just large, they are historical anomalies. By 2025, the capital expenditure, or CapEx, of the major hyperscale technology companies is projected to surpass $405 billion. To put that in perspective, that is larger than the GDP of most nations on Earth. It is a level of investment that exceeds the Manhattan Project or the Apollo program, adjusted for inflation. But unlike the Apollo program, this is not being funded by taxpayers for national prestige. It is being funded by corporate debt, the shift from equity to debt. For the last decade, big tech was cash rich. They funded their growth through their own massive profits. But the AI arms race is so expensive, so resource intensive, that even their cash piles are not enough. We are seeing a structural shift from equity-funded growth to debt-funded growth. Amazon is raising $15 billion. Google raised $25 billion in debt. Meta issued $30 billion in corporate bonds. Oracle, a company already sitting on over $100 billion in debt, is adding billions more. This year alone, debt issuance from the tech sector has reached record highs. Why? Because they need to buy the chips. They need to build the data centers. They need to secure the energy. The market's blind spot. The credit markets are pricing this debt as if it were risk-free. The quota's spread. The difference between the interest rate corporate giants pay and the rate the US government pays is less than 1%. This indicates that investors believe there is almost zero risk of default. This is the first sign of a bubble. When risky behavior is priced as safe, the market has lost its ability to measure danger. Investors are assuming that because these companies are rich today, they will be rich tomorrow. But history tells us that when companies pivot to hyperscale borrowing to fund a technological speculative mania, the result is rarely stability, it is fragility. If you take only one concept away from this investigation, let it be this: duration mismatch. This is the technical term for a very simple, very deadly mistake. It happens when you borrow money for a long time to buy something that lasts a short time. Imagine taking out a 30-year mortgage to buy a sandwich. You eat the sandwich in 10 minutes, but you're paying for it for 3 decades. By the time you pay off the loan, the sandwich is a distant memory, but the debt remains. This is exactly what big tech is doing with AI hardware. The perishable asset. The core asset of the AI revolution is the GPU, the graphics processing unit, specifically the chips made by Nvidia. These chips are miracles of engineering, but they have a fatal economic flaw. They rot, not physically, but economically. The pace of innovation in AI is so fast that a state-of-the-art chip today is obsolete in 2 to 3 years. Nvidia releases a new generation annually. The new chips are faster, more efficient, and necessary to stay competitive. So Amazon, Google, and Microsoft are issuing bonds with maturities of 10, 20, or even 50 years to buy chips that will be trash in 36 months. The refinancing trap. This creates a free cash flow headwind. Because the assets depreciate so fast, these companies cannot just buy them once. They have to replace them continuously. Every 3 years, they have to rip out the old servers and put in new ones. This means they must perpetually borrow more money just to stay in the same place. It is a treadmill of debt. As long as interest rates stay low and stock prices stay high, they can manage it. But if rates rise, or if the market sours on AI, the cost of this treadmill becomes crushing. We are seeing the creation of technical debt alongside financial debt. The infrastructure requires constant expensive maintenance and replacement, acting as a permanent drag on profitability. Debt is not inherently bad if it generates a return. If you borrow $1 billion and make $2 billion, you are a genius. But here lies the second, and perhaps more terrifying, part of the thesis. The revenue isn't there. The Gen AI divide. We are witnessing a massive disconnect between CapEx, spending, and ROI, return on investment. Research from MIT and other major institutions has revealed a shocking statistic. 95% of generative AI pilots fail to deliver a measurable return on investment. Corporations are spending an estimated $30 to $40 billion on these pilots. They are testing chatbots, coding assistants, and automated customer service. But in the vast majority of cases, the technology fails to integrate with actual business workflows. It hallucinates. It requires too much human oversight. It lacks contextual learning. The $600 billion Gap Sequoia Capital recently published a report asking the $600 billion question. Based on the amount of money being spent on chips and data centers, the AI industry needs to generate $600 billion in new annual revenue just to break even. Currently, the revenue is a fraction of that. The gap is being filled by hype and hope. Circular financing. So how do these companies show growth? Through a trick called circular financing. Here's how it works. 1. Big tech company. A invests $1 billion in AI startup. B. 2. Startup B is required, as part of the deal, to use that $1 billion to buy cloud computing services from big tech company A. 3. Big tech company A records that $1 billion as cloud revenue. It looks like growth. It looks like customer demand. But in reality, it is just the company moving its own money from its left pocket to its right pocket and paying a startup a fee to facilitate the transaction. This echoes the vendor financing schemes of the dot-com bubble and the off-balance sheet partnerships of Enron. It creates the illusion of a vibrant market where there is only a closed loop of capital. When the investment money runs out, the revenue vanishes. The crisis is not just financial, it is physical. The AI build-out is colliding with the hard limits of the real world. AI data centers are voracious consumers of energy. A ChatGPT query uses 10 times the electricity of a Google search. As these models grow, their hunger for power grows exponentially. Forecasts suggest that by 2030, data centers could consume up to 20% of the entire United States electricity supply. This is a staggering increase from just 2.5% in 2022. The infrastructure funding hole. The U.S. utility grid is aging, fragile, and debt-ridden. It cannot handle this load. To meet the demand, the utility sector needs to invest trillions in new power plants, transmission lines, and transformers. Who pays for this? The utility companies are already heavily indebted. If they borrow trillions to build power plants for AI data centers, they are taking on massive risk. What happens if the AI bubble bursts and the demand for that power evaporates? We face the risk of stranded assets, billions of dollars of power plants built for a customer that no longer exists. This creates an energy debt that will be borne by taxpayers and utility ratepayers in the form of skyrocketing electricity bills. We are already seeing this. In states with high data center concentrations, residential electricity prices are rising to subsidize the infrastructure for big tech. It is a transfer of wealth from the household to the data center. While the retail investors, the regular people, are buying the hype, the smartest money in the room is quietly heading for the exit. Michael Burry's warning. Michael Burry, the man who famously predicted the 2008 housing crash, has been sounding the alarm on the semiconductor sector. He has pointed out the discrepancy between revenue and depreciation. He argues that companies like Nvidia are effectively dragging out the depreciation schedules of their assets to make their earnings look better than they are. If you depreciate a chip over 5 years, your profits look great. If you admit the chip is worthless in 2 years, your profits disappear. Burry is betting that the accounting is hiding the reality. The insider sell-off. But it's not just Burry. Look at the insiders. Jeff Bezos, Mark Zuckerberg, Jensen Huang. The CEOs of these companies have been selling stock at a record pace in 2024 and 2025. Hedge funds and institutional investors unloaded more than $67 billion in tech stocks in early 2025. This was the biggest net sell-off of tech shares in years. When the people who run the companies and the people who analyze the companies are selling, and the only people buying are retail investors and passive index funds, history tells us we are near the top. And you might ask, Why should I care if Google loses money? I don't own Google stock. The problem is that you do, or rather, the economy you live in does. The danger of the AI bubble is not just that stock prices will fall, it is that the debt will turn toxic. The NBFI link. Much of this corporate debt is held not by traditional banks, but by non-bank financial institutions, NBFIs, hedge funds, private equity firms, and pension funds. These institutions are less regulated and more opaque than banks. If big tech faces a monetization reality check, if they realize they can't pay back the debt because the AI is not generating profit, the value of those bonds drops. Pension funds, which are legally required to hold safe assets, are loaded up on this debt. If the credit rating of big tech is downgraded, pension funds are forced to sell. This triggers a fire sale. The concentration risk. Furthermore, the S&P 500 is more concentrated today than at almost any point in history. The Magnificent Seven account for the vast majority of the market's gains. If they sneeze, the market catches a cold. If they crash, the market goes into cardiac arrest. Passive investing means that everyone's 401k, everyone's retirement account, is mechanically tied to these 7 companies. A collapse in AI capex wouldn't just hurt tech bros, it would wipe out the retirement savings of teachers, nurses, and firefighters across America. History is littered with the carcasses of new eras. In the 1840s, it was British railroads. Investors poured fortunes into building tracks to nowhere, believing that trains would generate infinite wealth. They didn't. The tracks remained, but the investors were wiped out. In the 1920s, it was the radio and the automobile. They changed the world, but the stock bubble built around them still crashed, leading to the Great Depression. In the 1990s, it was the internet. The internet was real. It did change everything, but the companies that borrowed billions to build fiber optic cables went bankrupt. AI is real. It will change the world. But the financial structure being built around it is a classic debt-fueled mania. It is built on the assumption that demand is infinite, that depreciation doesn't matter, and that debt is free. All 3 of those assumptions are false. The duration mismatch is the fuse. The lack of ROI is the match. And the $4 or $5 billion in debt is the powder keg. When it blows, it won't be called a tech correction. It will be called a solvency crisis. The question is not if it will happen, but when. And when it does, the transfer of wealth from the believers to the skeptics will be absolute. This is the financial coin historian. We don't predict the future, but we do read the balance sheets. And right now, the balance sheets are screaming.